Something is breaking in the economy, and it is happening during one of the strongest looking markets in years. The consequences could affect your job, your savings, and the price of almost everything you buy. So why do so many of the warning signs seem to be hiding in plain sight? If you ask most people what a broken economy looks like, they picture a stock market crash, bank failures, or lines outside unemployment offices. They picture panic. They picture headlines screaming disaster. But economies rarely break that way at first. More often, they begin breaking while everyone is still spending money, still going to work, and still believing things will somehow return to normal. The strange part is that the economy is not a machine. It is a collection of incentives, millions of people making decisions based on what they think will happen next. And when enough people start behaving differently, the entire system can change shape long before the headlines catch up. Consider a simple question. Why are so many people feeling poorer even when unemployment remains relatively low? For decades, there was an unwritten promise: work hard, earn more, save consistently, move forward. That promise was never perfect, but it was understandable. Today, something feels different. A growing number of households are earning more dollars than ever before, yet feel less secure than they did years ago. At first glance, that makes no sense. Then you look deeper. Economist Richard Easterlin became famous for studying a strange contradiction. As countries grew wealthier, happiness did not always rise with income. Once basic needs were met, expectations often grew faster than prosperity itself. The result was a treadmill. You ran harder but felt like you stayed in the same place. Now combine that with rising housing costs, insurance premiums, education costs, and everyday expenses. The treadmill speeds up. What feels like personal failure may actually be a structural shift, but that is only the beginning. One of the most revealing signals comes from credit cards. For years, credit cards were a convenience. Then they became a lifestyle. Now for many households, they have become a bridge between today's bills and tomorrow's paycheck. The problem with bridges is that they are supposed to be temporary. When they become permanent, something underneath is changing. Consumer debt has climbed to levels that would have seemed shocking to previous generations, yet many people continue spending. Why? Behavioral economist Drazen Prelek found that paying with credit weakens the psychological pain of spending. Your brain experiences the purchase differently when the payment is delayed. The pain arrives later, the purchase arrives now. That sounds harmless until millions of people do it simultaneously. Suddenly, the economy appears stronger than it really is. Stores stay busy, sales remain high, companies report healthy revenue, but underneath, more activity is being financed by future income that has not been earned yet. The economy begins borrowing confidence from the future. History has seen this movie before. During the years leading up to the 2008 financial crisis, rising home prices created a powerful illusion. People felt wealthier because their houses were worth more. Banks felt safer because collateral values kept rising. Investors felt smarter because profits appeared endless. The system looked healthy right until it wasn't. The important lesson is not that another 2008 is coming. The important lesson is that major financial shifts often look reasonable while they are forming. That is what makes them dangerous. There is another crack forming in a place most people never think to look. Productivity. Productivity sounds boring. It sounds like a word economists use to make simple ideas complicated. In reality, productivity is just how much value is created from a certain amount of work. Historically, when productivity increased, living standards often improved. Workers produced more. Businesses earned more. Society became richer. But something unusual has happened in recent decades. Technology has become dramatically more powerful, yet many people feel financially stuck. How can both be true? Part of the answer lies in who captures the gains. A company can become more efficient without every employee becoming more prosperous. Technology can increase output while concentrating rewards. The economy grows. The experience of the average person may not. This creates a strange illusion. The scoreboard says things are improving. Many people on the field feel like they are losing. That gap matters because trust is one of the most valuable economic resources in existence. When trust weakens, behavior changes. People delay purchases, they avoid risks, they save defensively, they become more cautious, and those individual decisions eventually shape the economy itself. This is where psychology becomes more important than statistics. In the 1930s, economist John Maynard Keynes described something he called animal spirits. He was talking about human emotion, confidence, fear, optimism, pessimism, the forces that influence economic decisions even when spreadsheets say otherwise. A confident consumer spends differently than an anxious one. A confident business hires differently than a nervous one. And right now, many people are sending mixed signals. They are spending money while feeling anxious, working while feeling insecure, investing while fearing a downturn. That contradiction should attract attention because systems under stress often produce contradictions before they produce crises. Look at housing. For many younger adults, buying a home increasingly feels less like a milestone and more like a distant dream. At the same time, existing homeowners often benefit from limited supply and rising values. The same market creates opposite realities. One group feels locked out, another group feels protected. That division matters because housing is not just shelter, it is one of the primary ways households build wealth. When access changes, wealth formation changes too, and when wealth formation changes, society changes. Few people notice these shifts while they are happening. They only become obvious in hindsight. The same pattern appears in retirement. Many workers are responsible for managing their own future through retirement accounts and investment choices. That sounds empowering until you realize millions of people are expected to make complex financial decisions they were never trained to make. The responsibility moved, the expertise often did not. Another hidden issue is that modern economies increasingly reward ownership. Ownership of businesses, ownership of assets, ownership of intellectual property, ownership of real estate. Labor still matters, but ownership often scales faster. This helps explain why two people earning similar incomes can end up living radically different financial lives. One owns appreciating assets, the other consumes everything they earn. The gap widens, not overnight, over decades. Now consider one final signal. The economy has become extraordinarily efficient at turning attention into money. Social media platforms monetize attention, streaming services monetize attention, advertising networks monetize attention, even many news organizations monetize attention. The challenge is that attention is limited. Every company wants more of it, every platform competes for it, every notification demands it. The result is an economy increasingly optimized to influence behavior, not because anyone is evil, because incentives point in that direction. And incentives shape outcomes, always. That idea explains far more about the economy than most people realize. When incentives reward debt, debt grows. When incentives reward speculation, speculation grows. When incentives reward short-term decisions, long-term thinking becomes rare. The economy is not breaking because everyone suddenly became irresponsible. The economy may be straining because incentives and outcomes are drifting further apart. That distinction matters, because it changes where you look for answers. Many people spend years blaming themselves for problems that are partially systemic. Others blame the system for problems that are partially personal. Reality is usually more complicated. The most important economic shifts happen when personal behavior and system incentives collide. That collision is happening now, and it helps explain why so many people feel a strange sense of instability even when traditional indicators appear relatively healthy. This brings us back to the original question: what does a broken economy actually look like? Maybe it is not collapsing banks. Maybe it is not market crashes. Maybe it begins when millions of people start feeling disconnected from the results they were promised, when earning more no longer guarantees progress, when debt quietly replaces growth, when ownership matters more than effort, when confidence becomes fragile, when trust begins to erode. Those changes rarely arrive all at once. They arrive gradually, quietly, almost invisibly, until one day everyone notices the consequences, but nobody can remember exactly when the shift began. The biggest warning sign is not a number on a chart. It is the growing gap between what people are told the economy is doing and what they experience in their own lives. Because when enough people stop believing the story changes. And that is why something may be breaking in the economy. Not because the system is suddenly collapsing, because the assumptions holding it together are slowly starting to crack, and now you know it might not be what the headlines are looking at.